Good day, fellow investors. The Schwab Dividend ETF is way better than the S&P 500. There were so many comments when we discussed value ETFs about the Schwab Dividend ETF that did well over time, so why not take a look? We'll discuss the risk and reward, we'll go through the top 10 positions, and why it is better, because fundamentals matter, and that's also what I did when I wrote my PhD. I looked at fundamentals over a long period of time, and those businesses with better fundamentals compared to price provided better investment returns. And let's now immediately look here. If you look at the price to earnings ratio of this fund ETF is 18 compared to the 30 of the S&P 500. Price to cash flow is 10, price to free cash flow 10, which means 10% cash flow yield, good return on equity, and okay, price to book ratio, it's a little bit high, but okay. Keep in mind the yield on this is 3.5, compare that to the S&P 500, and we are at a 3x, 3 times higher dividend yield. And what is even more importantly, I went to look at the distributions here. These are the distributions from 2015, 4 distributions per year, $1.14. Then I compare those to this year. So we have $2.45, a little bit higher in 2023. But the most important thing is that since 2019, distributions grew at a pace of 7% per year. If I look at the distributions growth from 2015, so 15 to now, we are at 8% per year dividend growth. If I compare that to the S&P 500 dividend growth, we are below that actually. Last year was 6%, but then I made the calculation from 2015 to 224, the growth of the S&P 500 dividend was 168 compared to the Schwab Dividend ETF of 214. So almost twice the growth there. Let me tell you something that Wall Street doesn't want to hear, must not hear, and that is, guess what? Buybacks don't work. Buybacks at extremely expensive prices don't work. What all the companies in the S&P 500 are doing doesn't work, because this dividend ETF is beating the heck out of the dividend growth of the S&P 500 companies that are doing all these crazy buybacks, because the buybacks should increase the dividend per share. And guess what? It doesn't. But that's a different story. Now, let's go into the businesses. This is approximately 40% of the ETF is in the top 10 companies, which is something I don't like with ETFs, that everything is concentrated in the top. But okay, let's look a little bit at the companies. Blackrock, P ratio 26, dividend yield a little bit shy of 2%, still better than the S&P 500. And as long as markets keep growing, as there is more money in the system, more investments, BlackRock will keep on growing their fee shares, growing their dividends faster than the S&P 500. They did some repurchases, but just 13% over a decade. That's not that much compared to the rest of the S&P 500. They have now a global business. They make most money on their base fees, and as long as they have assets under management, they will make more and more money. Great business. They are just a fee collector globally, providing you the ETF services and all that you adore, and for that they get a small fee. Great business. The risk is always a crash. If assets under management fall, so does the fees, so does the P ratio, so does everything. But over the long term should do okay. Then we have Cisco. We discussed Cisco 2 years ago when I told you it was back to value from a risk and reward perspective. The stock price was 45. Now we are at 60, so there was some increase there in prices. The P ratio is still better than the S&P 500, the dividend yield, and they are focusing on their dividends. They're also doing share repurchases, as long as business as usual for Cisco should be okay. It's cheaper, it's a good business. There is always this recession risk that investments slow down, and therefore Cisco also gets hammered. That's a given with these companies. Bristol Myers, now when it comes to pharma, I think the 10th position is also Pfizer, and dividend yields are good there, but when it comes to pharma, it is always a little bit of a lottery. They're investing in all these kinds of things, the pipeline, the this, the that, and you never know what will be the miraculous drug against fatism, against cancer, against whatever. And therefore, there are always these ups and downs with these pharma companies. And I'm not a specialist, but I guess if the ETF is diversified, they will likely keep collecting the dividends a little bit more from those pharma companies doing well, a little bit less from those pharma companies doing badly. And when it comes to pharma, unfortunately, people are using more and more drugs, and they don't take my main medicines, which is when you don't feel well, go take a nap. But that's just me. I haven't been to the doctor more than a decade. And the thing is that when you invest in pharma, if you're diversified, you should gain the benefit of the whole market. Very hard to know which one will nail it. And therefore, okay, dividends are there and that's it. Let's go to Chevron. I'm going to tell you now that's fairly priced. These are the cash flows reinvested. It's all an oil game. Oil is down, and therefore also Chevron is down, but more about oil tomorrow in a special video, where we'll also touch on Occidental tomorrow. Then we have Verizon. Verizon, it's an interest rate game. If interest rates go down, Verizon will go up. If interest rates go up, Verizon will go down. In the meantime, you are collecting a good dividend, and that's the name of the game. This is not a bad dividend, and you can play around with Verizon there, as the ETF does. Altria, same story there. I used to look at it when the dividend yield was 10. Now I think the market likes it a little bit better, likely because interest rates are going down. And I don't know for how long, but they are really defying gravity, and they are keeping paying these great dividends over time. Good for a diversified dividend ETF. UPS is paying a dividend, but looks like in trouble, and something is going wrong there. When you look at the presentation, investment presentation, and the first presentation talks about transformation costs and things like that, strategy, you know something went wrong there. If I look at the results, they are still growing. The profits, highly competitive environment, a little bit down. Okay, non-GAAP, they are up. They say the Q2 will not only be the bottom, but a turning point for their performance, and their revenue and profit will return to growth, which they did. The outlook is for slow and steady growth going forward, revenue increases, the structural benefits are there, and the free cash flows are there for the dividends over time. Nothing wrong with it. Year to date, Q4 should be a little bit better, and they have enough for the dividend and hopefully for growth. The risk, of course, the market is pricing in something when you see the stock price, and what the market could be pricing in. If I'm looking at BMO's summary, and they upgraded UPS to a stock price of 150 as the quarter turned, but they expect lower interest rates, potentially recovering industrial economy to support a return to low single-digit growth in B2B volumes. Of course, if interest rates don't go down, if there is a recession, UPS will suffer further. But it is a highly competitive environment, so I'm not really a specialist on UPS. But when you look at it at a whole, the dividend is there. So again, something to think about from a diversified perspective. Some of these businesses will do well, some not. But when you are diversified with a good base quality dividend, you will likely do good, as we have seen that the ETF did well over time. Texas Instruments, P ratio 35, but they are investing good dividend yield, and they are in an investment cycle. over the 21 years, they have increased the dividends, which then increase, again, the ETF dividend. They have also decreased share count from buybacks, good cash flows, all well, and they are now investing in the next cycle. So their capex is high now, which lowers free cash flows, and we are also in a downturn cycle of the semiconductor market. Things are bad now. That is reflected in the high P ratio that should revert, but the market is already pricing in some improvements there, and they are positioning the company to grow, and this is their scenario. They are investing, and if things go as planned, if the market recovers, then there will be 6 billion more in revenue. If it remains flat, they expect 20 billion in revenue. That is something that we cannot know depending on when the semiconductor market recovers. For now it looks bad, but they also expect that still a year of high capex, and then the capex will go down to 2 billion from 5, and that should add another 3 billion of free cash flows for dividend and buybacks, which should then push further to growth. You can see here the elevated capex that should allow for higher free cash flows going forward depending on the trend. The free cash flow per share should then go to, depending on the revenue scenario, between 8 and 12, let's say 10, but that is still 5% on the stock price. Okay, relatively cheaper than the market, but still expensive from an absolute perspective despite being a great business over time. So this is the summary of the companies. Tomorrow, oil. And the conclusion is that this is better than the S&P 500, better on the yield perspective, better on the dividend perspective. There is always a recession risk, and there is always the risk that interest rates go up or stay higher, or that the Fed doesn't lower, or interest rates don't go down. And then we can simply see that if there is a recession on top of it, earnings go down, dividend payments go down a little bit, and the market suddenly expects a 5% dividend yield. So it is way better than the S&P 500, way cheaper, but that's a relative basis. Value investing is about absolute investing. So I want these companies growing at 7% and at 6-7% dividend yield, which means this should be 50% lower. Nothing wrong with it. It's just whether you are S&P 500 investor, relative investor, or absolute value investor. It's just about where you are. I'm saying this will do good over time. No worries there.